Joining me now, Chris Hyzy, Chief Investment Officer for Merrill and Bank of America Private Bank. It's good to talk to you today, Chris. Just answer my question there. Do you think that the markets really need the Fed to cut to keep steaming along?
Well, I think, right now in the short term, the enthusiasm at least taking off and backing away from the potential cut that everyone expected to be coming in December is putting the weakness on the market. But does it really need it? It really doesn't. The market has been factoring in a much better profit cycle, looking all the way through 2026. Of course, having easier financial conditions and more liquidity in there is going to help in the short term. And we do expect that through 26. But pausing or having a cut in December is more of a very near-term small hurdle.
You think that there's a kind of flywheel that is keeping equities humming along?
Right. If I could peg it down to three specific areas. Obviously, we all talk about CapEx. CapEx in general, particularly in artificial intelligence. But what we think is deeper than that is just not AI. It's this entire digital infrastructure, which has a lot more room to go than just one vertical, which is large in AI. The second area is boomer spending. You could see it in travel, leisure, and entertainment, and it's masking over some of the lower end weakness that we are seeing. But in aggregate, consumer spending is still healthy. And then finally, it comes down to profit momentum. And that's where the flywheel starts to come in.
So, Chris, when we're looking at the yields, are you expecting to see more steepening?
We certainly do, because the short end coming down, looking through over the next 12 months. And what Rick said is absolutely very important. Again, he said something very important. When you think about the action that's going on today, a little bit less liquidity, market doesn't like to be disappointed. The back end going up. It didn't go up as much as it did back in April, obviously, but that does take some of the euphoria and froth out of the equity market, and it adds some uncertainty out there. And I would be taking advantage of this weakness today.
All right. We heard from Steve Leisman that there is some encouragement for the Fed to look through whatever inflation the tariffs are bringing with them to the table. There's a lot of skepticism this week about this AI bubble, with the social media post from Michael Burry and Jim Cramer laying down some serious concerns about the debt financing for some of the big data centers. When you're looking at portfolio strategy, what's your best advice right now about where we're heading into the last month of the year and how we start 2026?
Well, we always try to figure out, is the narrative holding? And we look at our data through the Bank of America Institute, the consumer data, and spending is still around normal in aggregate. Are there weak spots? Yes. So we check the box and we say, is the consumer healthy enough to continue this into 26? The answer is yes. Then we look at liquidity on a short-term basis. That should start to pick up again in December. Then we look at profit momentum and margins. That's critical for small caps. All of those things are gathering better momentum as we go into 26. So we're going to stay overweight equities. We want to use weakness in markets like today when there's no real fundamental news out there. And as far as AI being in a bubble, bubbles happen when debt financing comes in at the later stage of the build out, and that debt financing can't substantiate some of the cash flows that are coming back in off of that CapEx to pay down that debt. We're not there at this point. Should we be on guard and always look for that? Yes, but we're not even at that level yet in total spending or in debt financing.
I want to take a look at the European stocks right now. I'm looking at the DAX. It's off by 1 1/3 today. The FTSE's off by 1%. But you saw some of these stock exchanges hitting record highs this week. It's been on fire. What's your sense of international investments versus U.S.?
That's a great question. Obviously, over the last decade or so, you had a little bit of a head fake every few years in non-dollar assets, particularly in the developed world and occasionally in the emerging market world. We're neutral across the board. We closed out our underweight earlier in the year, around January, February of this year. So we've been riding the momentum there. Right now, growth is slowing a little bit in Europe and the UK. Japan is picking back up again. The emerging markets, because of their exposure to real assets, is extremely heavy. They have a lot of exposure to tech, financials, and consumer discretionary. sounds like the United States. So we're going to continue to ride this momentum. And for dollar-based investors, having at least a neutral allocation makes sense to us.
All right. Chris Hyzy of Merrill and Bank of America Private Bank. Great to see you today. Thanks for your perspective.